And now it's time to talk about plumbing. We actually talked about plumbing in that Christmas countdown with the 11 pipers piping. So take it away, Mr. McManus, and tell us about the plumbers that are Cisco.
I'm going to take a look at Cisco Systems. It's a favorite, I think, of any IC/Better Investing members and people here on Manifest Investing. It's a company that I own. In fact, I own all the companies that I've presented today. It's a company actually that I've been buying recently. I think most of you noticed that the price took a little bit of a plunge not so long ago when the CEO decided to fess up and say that earnings or at the top line might be slowing down next year. So it presented itself with a good opportunity to buy. Let's move on to the next slide. Is this the SS? No, okay. So just a little bit of history. It's a plumbing company, as I said, basically plumbing for the internet. It was founded in 1984 by some Stanford graduates, and when I started watching Nightly Business Report back in the early 90s, it was always on the most active list on the NASDAQ. I heard Cisco all the time. Didn't buy it then. Could have. It went public right about the time when I started to get investing in stocks in February of 1990 at a price of $23.75. And here's the painful thing. That price, split adjusted today, is 6 cents. So $1,000 invested in Cisco at the IPO is today worth $333,500. So I I'm sorry I didn't really get involved back then because I did some reckless things as all beginning investors do and thought IPOs were the best thing to make money. It's currently trading at $20.25, and that means over the last 20 years it's had a compounded growth rate of just over 32%. It doesn't pay a dividend. I've read online a lot of speculation about whether it might in the future, given the amount of cash that it has. But it has had steady growth over a long period of time, with a notable exception when the stock went on a binge like everything else associated with the internet in the late 90s. And it had a little bit of a crash in 2001 when it wrote off oodles of inventory, and there was a bit of a downturn. So moving along to the next slide, and it just gives a few details about the company itself. Let's see if it'll click to the next one. Have I got control here?
No, I think Ken has it. Ken, are you able to click us to the next slide?
I seem to be frozen, Mark.
You want to switch to me?
How about the...
There we go.
Excellent. So it makes it is a plumbing company. It makes switches, go left, go right when these little internet packets come along, and makes routers, the thing that really do the legion's share of the work on the internet, connecting networks together. It makes the internet run, and I think a lot of people probably, if you look around your house, have a Cisco product sitting there, maybe a wireless router or something like that. But a lot of people have Cisco products, but the real work is the products that it sells to corporations and communications companies, cable companies, etc. It handles voice, images, everything that you can call data. And in fact, it really has three big areas. About 40% of its business is switches. These are kind of dumb things. Routers, a little bit smarter. It's about 22% of its business, and the rest is advanced products of various types, and that includes things like WebEx and home security products, home networking, a range of different things. It has a lot of competitors, needless to say, but it dominates the market. Juniper, Motorola, Qualcomm, Research in Motion, all are nipping at its heels in different areas. But it owns 70% of the switch market, and it's dominant in the router market too. It owns about half of that. The interesting thing about where Cisco is, I like to talk about a moat, and it has a fairly good moat in its key areas, switches and routers. And the growth really is going to come from the advanced products. But it has a moat because of brand loyalty. IT people do not like downtime, and they don't like any risk of downtime. And switching to another product that's not Cisco is a risk. It could involve downtime. So chances are that once Cisco is in a company, it will stay there. There's tremendous brand loyalty because of risk of downtime. So let's move on to the next slide. Now, as I said, it has had bad news. The CEO decided to give a little bit of guidance to Wall Street and advised them that the top line would decline. I will look into the inventory in more detail. I've done that before for Cisco, and I'll talk about what I find on Manifest Investing. And when I say look into the inventory, I'm going to look at accounts payable, revenue quarter over quarter. I'm going to look at raw materials, work in progress, and finished goods, just to see if there are any trends there that could have signaled what the CEO came out with in November that caused the stock to dip. Certainly, if you recall in 1999, when you started to do a detailed inventory analysis of Cisco, and Lucent for that matter, both of them, it was really very clear that something bad was in the offing for the internet because inventory was piling up. Not for 3 or 4 quarters, but 6 or 7. It was really starting to pile up towards the end of 1999. But the fear is that next year things are slowing down. And the great thing for us long-term investors is that the stock took a bit of a dive. Apparently Wall Street doesn't like to digest truth that well, and I made the comment it's like eating broccoli. It's good for you, but for some people it's hard to digest. So let's skip on to the next slide. And I use TD Ameritrade as one of my brokers, and I like some of the reports that come in there, and I like the way that the Street ratings looks at Cisco or any company in the context of its competitors. You see towards the top right, you see Cisco in blue. The vertical axis, the one heading towards the heavens, is revenue growth, trailing 12 months, and the horizontal one is earnings. And the fact of the matter is that if you're right on the line, then revenues and earnings are in tandem. Cisco is pretty close to that line, that diagonal line that goes from bottom left to top right. But it's doing pretty well. Research in Motion probably looks a little bit better. Haven't looked into that company. But Cisco is the 800-pound gorilla in the market, and I frankly like 800-pound gorillas. Let's move on to the next one. It is a trading stock, by the way. You'll notice high volumes in Cisco. A lot of people buy and sell that thing, and I actually like that. They have fads. They'll go from one stock to another. But when they trade, for some reason, they look at these charts, and the hope is that they'll do something bad to the price and knock it down low for a while so I can buy more of it. So I don't really mind if they're in there buying and selling to each other. I like it, actually. Analysts have sales growing for the next few years at about 9%, and that's not bad. I mean, for the last 10 years compounded, the top line on Cisco has grown by 9.5%. And the consensus is a buy. 20 out of 46 analysts that are surveyed have Cisco rated as either a buy or a strong buy. No one has it as a sell. The bulk of the rest have it as a hold. And it's currently trading at a 52-week low, close to it. It's a little bit higher today. But it's been in the $19 to $20 range, and that's down from $24 and change a few weeks ago. It has really strong financials. There's a lot of good things about this company, lots of cash and equivalents on the balance sheet. I kind of jokingly say here that for a $112 billion company, it has too much cash. Will it pay a dividend? We'll see. You know, maybe the story here is that it can't find anything out there to buy, and we all like to see lots of mergers and acquisitions because that's a sign that the recovery is happening. Companies are beginning to recover when they walk out and buy their competitors. Cisco has been in the purchasing business and has integrated the parts that it's bought very, very well. But it hasn't really been on a super buying binge, I think, recently. Given the amount of cash that's on its balance sheet, it could do something with it. It has reasonably good income growth. It's nice and stable and growing, and cash flow is fine, too. And on the manifest summary, high-quality company, 77, with a projected annual return of 15.5%. Sales growth forecast here is a bit higher, 10.2%. Many analysts are around that number. The number I picked off was a little bit lower, and the number that I used actually in the SSG that will come up in a second is 9.5%, the historical range. But it's a good company. It looks good, and motley fool people like it. So you can see this is page 1, part 1 of the stock selection guide. Over on the left is 2001, when internet companies were recovering, starting to recover at least from that binge that we call the bubble. So it had negative earnings in 2001, but sales have grown reasonably at a steady clip ever since. It took a downturn with the Great Recession, as many companies did. But as I said, I have sales growing at 9.5%. I use the preferred method, or the whatever the politically correct way to call that is nowadays. I keep forgetting. And came up with an earnings per share growth rate of 11.5%. Let's move on to the next slide. So we look at part 2 of the SSG. Profit margin and ROE are trending down. Bad sign. Debt is trending up a little bit. This is a sign that Cisco, not surprisingly, is a maturing company. Its super heavy growth rate phase is over. It's now mature. I keep talking about the dividend. It would not surprise me at all if in 2011 or 2012 they start giving some of that cash back to shareholders. I was caught off guard when Microsoft started doing it. I thought it was a little bit early, but right on the money, and maybe Cisco should too. But there are areas where it can grow in the future. The PE ratio has been relatively stable, great, and the earnings per share took a bit of a dip during the Great Recession, as you would expect. I mean, with some of these hardware products, you can actually defer purchase for a year or two without any problem, and certainly people clearly did that when the recession held and people wanted to really husband their cash, gather their cash, cut back on spending, etc. And then in part 4, it's in the buy zone. I throttled back in the PE ratio a little bit, got an aggressive low price. I would be surprised if it goes as low as this. But, you know, there's a lot of wiggle room there because the upside-downside ratio is 6 to 1 or 6.5 to 1 thereabouts. So from an SSG point of view, it looks to be in the buy zone. From looking at Manifest Investment, which gathers information from a lot more sources, it appears to be a buy as well. So that's why I'm adding it to the list. So to summarize, Cisco is dominant in its market. Apparently the CEO believes there are rough waters ahead. Hey, Cisco's been through this before and survived. It's been through worse. But hardware will need to be replaced, and I think Cisco is in a good position as the economy starts to recover more and more. Years ago, I would have said Cisco is a core holding. Now, I'll keep monitoring this company because I think it is maturing, and its growth days are over. But it's still, as I said, the 800-pound gorilla, which I like. And I do expect margins to be squeezed, but I'll go into Cisco in more detail and publish what I find on MI. That's it for Cisco.
Thanks, Hugh. Good deal. We did feature Cisco on day 4 of the Christmas countdown, so you can go and check that for a little more on the background on Cisco Systems. With the stock price down in the 19 to 20 range, it sure did seem like it was beat up awfully bad. Just take a moment before we transition to our final presentation of the evening. Ken's going to talk about pork again this month. I would like to extend and make you all aware of our exclusive one-time special offer for investment clubs. Literally is an all-you-can-eat offer. If you're in an investment club and would like to explore this, you can literally provide all of the partners in your investment club with Manifest Investing for $169. Literally, you know, if it's 8 or 10 or 20 partners, you all get it for the $169. So if you'd like to explore that, get in touch with me. You see my email address there at the bottom of the page. This has been quite popular with investment clubs, and we really think it's going to be a way for us to explore increasingly more effective ways of supporting investment clubs and our entire community of long-term investors over the years.